Data is proving major home price declines in 7 U.S. cities. This information is probably not what you're hearing from the local realtors. And the bigger story is not only declining prices, but why these cities are leading the housing crash. This matters to anyone planning to buy or sell a home anytime soon. And if this is you, even if you live outside of these 7 cities, the data may be invaluable as you'll want to pay close attention to your specific market. Real estate data analyst Lance Lambert is collecting the most up-to-date housing market data with his proprietary program. I'm Todd Sachs, a Maryland real estate broker, and my job here is to bring you the most up-to-date information as it becomes available on the housing market. So you want to subscribe to this channel if you haven't already done so. Lance, welcome back.
Thank you for having me. Housing. There's always so much going on in the market, especially right now.
Yeah, you're not kidding. You're a very busy man these days, I'm sure. And I will add, very popular.
Well, I appreciate that. And I'm just, head down and in the housing data, trying to figure out what's going on at any given time.
Well, housing affordability has sort of left the house, as they say. It's a I guess, pun intended. It's a major issue in the U.S.
Yeah. When you zoom out, and you look at the affordability indexes, which they take into account home prices, mortgage rates, and incomes, right? We're pretty much at, one of the worst levels for housing affordability in, 3-4 decades. And really the only time in those traditional affordability measurements that housing affordability is worse is 1981, when mortgage rates were, 18%, and Paul Volcker had slammed, his foot on the brakes and really went at the economy to nip inflation. But those, when you look at it from those lenses, somebody who bought in 1981, the mortgage rate was a huge proportion of their monthly payment, right? And so as rates went down to 15 to 10, they got to refi and those payments came in line fairly quickly, right? Whereas in this environment, looking forward, even if rates come down some, the refi potential just isn't like it was in 1981, right? So this affordability squeeze could have a longer tail. That's the first part. The second part is if somebody bought in 1981 and they financed, yes, affordability is the worst ever, right? For their monthly payment. If they actually got a mortgage rate. But if they paid in all cash because home prices relative to incomes wasn't as big of a gap, it actually wasn't that bad, right? Whereas today, whether you're a cash buyer, because home prices relative to incomes are, at historic highs, or you're somebody who's financing and you are, taking out a mortgage and you have the mortgage rate, it's still a big affordability squeeze. So I think that's another part. And then the third part there is those traditional affordability metrics take into account home prices, they take into account mortgage rates, and they take into account incomes. What they don't take into account is property taxes and insurance. And so when you look at those two, and in particular, the home insurance, because that's a bigger piece of the pie now in 2024 than it was in 1981, the affordability squeeze right now is much closer to 1981 than people think. So John Burns has an indice that takes into account all 5: home prices, mortgage rates, incomes, property taxes, and insurance. And it shows us being much closer to 1981 than some of these traditional affordability metrics. So you're absolutely spot on there. There's a big affordability squeeze happening in the housing market, and that's universal because universally home prices overheated during the pandemic. Universally, mortgage rates spiked from 3 to almost 7 across the country. And then universally, incomes did not keep up with those two.
Yeah, it's a good point. I haven't heard it quite said like that, and that's really an accurate way to look at it. In my opinion, when you look back in the 70s and even before, you could buy a house at 3x or 4x your income. And a lot of people, only one working, outside or income producing person in the household where, we saw traditionally a lot of the women stayed at home and raised the kids, and the husband in this scenario that I'm explaining was the only one that was out working. So their income was enough to pay for the home. And we didn't see people jump around like they do now. I remember being in high school, and my friends' parents never moved. They basically stayed in the house, and a lot of them are still in the same house today. And now we call those starter homes and things like that. So we have derailed in a lot of different ways through the years, in my opinion. But anyway, let's jump right into the 7 cities where you're seeing the biggest home price declines. And we'll save the biggest price decline for last. So let's start with number 7. And maybe you could tell us as we're going through, Lance, as to maybe some of the causation other than what you've just mentioned for the bubble-ish activity in these cities that seem to be crashing the most. And whether it was is it an area that saw a lot of domestic migration? Were there a lot of job creations taking place where maybe corporations were moving their headquarters? If you have any of that information or can speak to it, and and whether or not it had a lot of political reasons, because I think we've seen the biggest political divide. I know. We leave politics out of the channel as much as we possibly can and not talk about certain things, but we did see a lot of what I saw migration out of a lot of blue cities to red cities and vice versa and things like that. So let's start. What's number 7?
Yeah. So right before we jump into it, I think just a couple points. For these 7, we're looking at metropolitan areas. So this includes the counties outside of the core area as well. Metros are calculated by commuting distance to the core county is how they do it. And if you think about a metro is really 2 things. It's a job market, right? And then it's a housing market. That's really what a metro is. So we're using metros, the 200 largest. And then the other thing is when you hear and you see a lot of these headlines in media about how nationally aggregated home prices are rising, those are nationally aggregated home prices. Even if the headline says home prices, that is, some methodology that's looking at probably repeat sales for single family homes, and it's aggregating it across the country. But the truth is right now, this is not like 2018, 2017, where almost everywhere is slightly moving up, right? In this market, yeah, there are some markets that are still kind of resilient, some in the Midwest, some in the Northeast, right? Southern California a bit, especially Inland Empire. But there are these markets, right, where this affordability squeeze is very acute. There's a swing in migration where the pandemic housing boom, these markets really overheated. A lot of people moved in, right? And there's still people moving into these markets now, but it's not like it was in 2020, 2021, early 2022. Things have changed. And so some of these boomtown markets that also, by the way, they have a good level of home building, right? That supply is still moving into the market. And builders got to move products. And if they have to, they'll discount, they'll cut prices, they'll do bigger affordability adjustments to move it. And so these markets have they have the shift in migration. So then local incomes are relied upon more to justify the home price. That's where they're getting in trouble. And then on the other side of the market, that new construction is still moving in. Builders have to move it. They do affordability adjustments. Prices look a little more interesting. The mortgage rate buydowns look a little interesting. So buyers who would have otherwise looked at the existing and resale market are like, you know what? I'll go to the new home builder. And so then those resale and existing homes have a little harder time selling, and that active inventory builds. So I just kind of want to set the tone before we jump into it. But number 7 here, Lafayette, Louisiana. So they are down 3% year over year for home prices. The indice I'm using here is the Zillow Home Value Index. And the reason that I like it is that it includes single family and condo, right? And sometimes the condo and some of the townhomes and some of these other things kind of get taken out. And this is the middle of the market. So the 35th percentile to the 65th percentile, the middle. So the lower end or the higher end, you could be seeing some different things, but this is the middle. So Lafayette, Louisiana, down 3%. And I think the big thing with this market, it's not necessarily the run up in home prices. It's not necessarily that they were a huge boomtown. It's the fact that actually, they've had some troubles from before the pandemic. And then now in this market, they're getting hit by a very big home insurance shock. So across Louisiana, the 3-year change in median annual home insurance premiums, a lot of the counties throughout Louisiana, they're up
Mm.
40, 50, 60, 70%. And in some cases, you can find some, I think, over 100% up. And what's interesting about Louisiana right now is that it was already a market relative to local home prices where people paid higher home insurance premiums. And so to go from a place where you're already paying a higher percentage to home insurance premiums to then getting hit by this bigger shock, I think that coupled with the fact that Louisiana has been a little choppier on the economic side. If you look at some of the distress levels in terms of getting behind on credit card payments and things like that, Louisiana's actually been on the higher end for the whole country for that. So I think a combination there is why Louisiana has been a little weaker relative to the rest of the country, and Lafayette coming in at number 7.
Yeah, and they're hammered by, I mean, I can just remember, with them being below sea level. I mean, hurricanes are a big deal for them. And so I could see where insurance would skyrocket. When we look at something like Louisiana, has this been since a lot of the markets really inflated during the, 2020, 2021 and going into 22? Was Lafayette, Louisiana, one of the areas that expanded one of the most in the country as far as home prices, or is it
wasn't.
these? No.
Yeah, it was. That's why it's very unique. The Louisiana story is very different than the story I set up earlier, the Boomtown story. They had, slightly below national appreciation for the pandemic housing boom. Now it's still a lot, right? You go up 30%, that's still a lot. But it's not the 70, it's not the 80% that we'll see in some of the boom towns that went up within 18 months, just popped right up. But so I think it's this affordability squeeze and the fact that there's some weaker economic and also some distress in that market is kind of what I'm thinking.
So do you think that they're going to continue this downward trend? What could turn it around?
Louisiana, that if you look at the active inventory and some of this data in Lafayette, they're not what I would call tightening up, right? Like it doesn't look like the market's tightening up in terms of like prices are about to shoot back up, right? Or shoot up hard. What I would expect though for this market for now, as long as the broader economic picture doesn't change, I think it looks like they're grinding sideways down, right? Like it's choppy and they're slowly, coming down for prices. How long that goes and all of those things, I think a big part of it will be the economy and where that setup goes. If you have a recession, right? This might be one of those markets where they could fall and 10% really fast, right? Or more. I would definitely say more vulnerable market and there's some choppiness there.
All right. So what's next?
Next up, number 6 is New Orleans in Louisiana, down 3.2%. And you will hear a bit of a reoccurring theme with these Louisiana markets. Down 3.2% year over year. This is a market that's down over 10% from peak. It's the insurance, right? It's the insurance for them. They didn't necessarily see as big of a boom as some of these other metros. This affordability squeeze from the insurance, coupled with the fact they did see home prices go up way more than incomes, right? And then the third factor here that makes New Orleans a little unique relative to some of these other Louisiana markets is the short-term rentals, right? And the local municipalities have went after some of these short-term rentals, and there was a pretty big short-term rental boom in Louisiana, and that really happened nationally throughout these short-term rental markets where the fact that during the pandemic, you couldn't do some of these other things, right? You couldn't go cruises, you couldn't go international travel. So more people looked to Airbnbs, plus people working from home who had money were like, you know what? I'll go take my family for a week, short-term rental. So the demand for short-term rental spikes, right? And at the same time, home prices are ripping. Mortgage rates are super low, 100-year low. And so people are like, you know what? These short-term rentals as investments are a great opportunity. So many people piled into it. And the thing about short-term rentals, when people buy it, it takes a bit of time to get it online, right? And some of these people are doing full remodels and all of that. And at the same time, that supply from short-term rentals is about to move into the market, the demand trajectory is no longer soaring, right? It's kind of started to flatline where, people are starting to go back into the offices, cruises come back, international travel comes back. And at the same time, that supply comes into the market. Now, the story of short term rentals is very much market to market. So you've seen some markets be a little more stable, right? They've kind of cooled down, but stable. And then you have other markets where things have shifted very quickly. And in some of those markets, the short term rentals themselves in some of these neighborhoods could be down 10, 15%, even if some of the metrics for that market show that they're flat or up one or up two. Some of it gets hidden on the short term rental side. And so I think the short term rental side is a part of the story for New Orleans.
Yeah, that's going to be an interesting thing to watch nationwide because, you see sort of like the pushback. You can't make people want to stay in a hotel. There has been a lot of desire for people to travel and stay in a short-term rental, not necessarily because it's cheaper, but because they can have their whole group in one place without having 4 or 5 hotel rooms. But it's interesting watching this back and forth because as HOAs are outlawing them, and across the country, and we're seeing places, Dallas comes to mind, where they, were banning short-term rentals, and then all of a sudden, now it's tied up in court, where that kind of hasn't pushed all the way through, where people are saying, hey, you've got both sides of it, right? You can't tell me what to do with my property if I want to rent it out short-term, but, the bigger complexity is, with a housing market shortage, is how many of these houses are being, partially occupied by vacationers, and what's the disruption like in the community being or living next to it? So yeah, I think Lance, it'd be a fun one to watch. Wouldn't say fun, but it would be an interesting one being in the business, both of us, to see how this plays out and potentially could flood the market and drop prices.
From an Airbnb, somebody who owns them, their perspective would be that some of these bans and the talk about the bans might actually be good for them, right? Because one of the things it does, it scares new entrants, right? There, because one of so much of the supply has come in from the people buying during the boom that has really caused the correction in the short-term rental market. Plus, the shift on the demand side no longer booming and kind of pulling back a bit. And so if, some of these markets are doing some of these bans, what they do when they do the bans is they usually allow a good number of people to keep them, right? And then they're really cutting down on the total number. That is good for some of these short-term rental owners, especially in this type of environment, in my opinion. And then just the general talk about Airbnb bans, I think that scares some of the people who would buy them and come in and compete with them.
Completely agree. Yeah, because I see it firsthand. When the rush was happening, I would get calls all the time of people wanting to buy Airbnbs, and now that's pretty much gone away. And like you said, in Baltimore City, and what I see a lot of these municipalities doing is they're saying, you know what? If you want to have an Airbnb, you can have it, but you have to live there too. It has to be your primary residence. So yeah, very interesting. All right, so what's number 5?
Yeah, number 5 is Naples and Marco Island metro area. They're down 3.2% year over year. Florida in general, and you will hear more Florida markets on this list. What's happened there is that they got hit by everything. Home prices ripped in Florida. Most of those markets are up 50, 60% from pre-pandemic levels during the pandemic housing boom. Really just shot up. And you could go and you could find zip codes throughout Florida that are up 80, 90, 100, 110%. I mean, Florida was really the epicenter, one of the epicenters of the pandemic housing boom, is so much of this migration from, very high cost markets like New York City, Seattle, San Francisco, Los Angeles. You go up the East Coast, you could probably hit Baltimore, Boston, and also some of these markets that were locked down more. And a lot of that migration went to Florida. Plus, there was a pull ahead for retirees, right? Where some people were really close to retirement, COVID happens, their stocks shoot up real quick and they're like, you know what, this is it. And so you have some of those families from the Midwest, Illinois, Ohio, Michigan, that were, kind of close to retirement, but instead of retiring in 2025, they retired in 2021 and moved down to Florida. And so the fact that the market overheated so much for prices, and then you throw in the condominium shock, where in uh, summer or fall 2021, there was the Surfside condo collapse, killed 98 people. That kind of really shook Florida in terms of the fact that once they realized they were deferring maintenance, the state legislature stepped in, tried to get to have more money put aside, right, for these repairs. And so you had the shock with the special assessments, the HOAs, and then the fact that some of these people who owned these condos were like, you know what? I'm done with this. I'm done. I'm not going to deal with all these insurance shocks, the HOAs, the special assessments. So you had some of these condos go up for sale. And then the buyers in the market were like, you know what? I don't really know what this monthly mortgage payment's going to look like in 2 years if I buy a condo. And so they're not selling. And if you look at the data for Florida, every 10 years back you go, they're having even harder time selling. So the condos that were built in 2000 have a harder time than the 2010s. The 1990s have a harder time than the aughts. The 1980s have a harder time than the 1990s. And so the condominium supply for active inventory has built as the buyers have just kind of, stopped looking at that market. And then we didn't even get into it as much, but this is a story in Florida, just like it is in Louisiana, really big home insurance shock to the market, where you go through Florida and you'll have, up 40%, 55, 60, 79, Miami-Dade up 39%. And this is just in 3 years. And the thing about Florida that's unique is that, similar to Louisiana, but even more so the case, is, people in Florida, homeowners, were already paying a lot more than everyone else in the country for home insurance. And so as a percentage of their home's value and of their monthly payment, it was already higher. So if you go up even more than the country percentage-wise on a dollar and a percentage of your monthly mortgage payment, that's a big hit. And so we've also seen that hit the market.
I get a lot of calls from people from Florida that are moving out, and many of them have been there for 20, 30 years, and they've been priced out with the, all the migration that Florida has experienced, domestic migration, and I guess a lot of the short-term rentals as well, people buying them thinking it's great to have a vacation spot in a place like Naples. I know several people that have recently bought condos in the last couple of years. But one of the scary things about condominium living, and I can remember, Lance, back in the '08 crisis, being down in Florida, and I had a friend of mine that was, really investing in Florida, in the Orlando area, and Doc Phillips and things like that, and places like that, and it was scary. You could buy an actual condominium, 2-bedroom, 2-bath condo for like $30,000. But what people don't realize, and you touched on it, is that as an owner of a condominium, you have to pick up where others don't. So when you have high delinquency rates where people are not paying their condo fees, and the condo association can't make the bills on the income that's coming in, they will do special assessments. Or like you said, if they're undercapitalized. For anybody watching this that's considering going into a condominium, or even an HOA for that matter, like Lance indicated, you won't know necessarily what your monthly payments are going to be from the day that you agreed to buy that property, right? That house in an HOA or a condominium association, because in your documents, you will make up the deficits, and or they can foreclose on you as well. So good information there. Naples, probably one of the wealthiest areas I've been to in Florida. So no surprise that as we see these luxury areas go through these transition periods, as you had mentioned, that we don't see even more declines in areas like Marco. Marco Island reminds me of one of these areas where you either have money or you don't, or better yet, you either work for the rich or and you live on the one side of the island, or you have tons of money and you're retired or whatever. You're maybe even a foreign investor that owns these amazing places. So, what's next?
Austin, Texas. And they have been on this for quite a while now, probably 30 months, is one of the bigger decliners. Austin is down 3.5% year over year, which might not sound like too much, but if you zoom out, they're actually down 21% from the peak in 2022. A lot of those declines happened right away in the second half of 2022. But they've stayed steady with the slow grind down. So they had a fast drop, kind of almost a flash crash in the second half of 2022 in the Austin metro area. And then since then, it's been a slow grind down. And the interesting thing about the Austin metro market is they only fell 8% during GFC, right? This is one of those, some of those Texas markets that didn't have those subprime loans because, they had went through their own crisis in the 80s into the 90s. And so they had gotten rid of a lot of those products. So it's interesting to see Austin be a market down so much when, most markets across the country are net down close to 20% from peak. And the story there in Austin is a boomtown story where they had a rush of people moving in during the pandemic, a lot of capital moving into the market where, there was a huge amount of liquidity rolling through the economy, when the Fed was doing its quantitative easing, buying up treasuries, buying up MBS, that money needed a place to go. And so a lot of the institutional capital deployed it to Austin. A lot of investors with big capital were deploying it to Austin. And so Austin saw a huge run up in home prices, 72% between March 2020 and June 2022. Austin was up 72%. And so the interesting thing is if you drop 21%, that doesn't mean that Austin's now up 52%. The math actually works out to where Austin's only up like 39% from pre-pandemic levels. And so Austin also had, some investors who were buying these properties, thinking that they were going to make their money off appreciation and not cash flow. And I've gotten this from on the ground reports. I've gotten this from different analysts. I've done some reporting there as well that this is the case. And a part of the reason is Austin was not just booming during the pandemic, Austin was booming before. And so investors saw a huge run up in prices and were thinking, you know what? I'm making my money on appreciation. And some of these guys got in over their skis and are now, some of these properties are coming up for sale that investors have offloaded. And so the market is rolling through that. And the other factor there is Austin is among the major metros in the country, talking top 50 here. They're the number one for is relative to their population base for single family home building, right? Those deep areas in the exurbs, Austin's building a lot around that metro area. And so as that supply came into the market, and the fact that builders kind of saw this coming in 2022, and some of them in Austin cut overnight 15, 20, 30% for prices, according to my reporting. And they did it real fast. They just ripped the Band-Aid off. They're like, we know where this is going for this market. We're just going to go meet the market. They did it overnight very quickly. And so that happened. And then into 2023, 2024, a lot of the buyers in Austin are like, do I go to the existing seller who, he's maybe come down 5% from peak, but he's really trying to get what he's not where the market is now? Or do I just go to this home builder who's already cut prices? Maybe they'll also give me a mortgage rate buy down. And so is that some of that buyer demand is pulled from the existing resale market to the new construction market in Austin? The existing sellers are having a harder time selling, and that active inventory there is built. And so if I can pull up the chart here, Austin, they have 9,800 active listings in the market. They had only 3,000 3 years ago during the pandemic housing boom in November 2021, and only 3,000 in November 2020. But the interesting thing is, if you go back to November 2019, they had 6,900 listings. So they're up 43% right now above pre-pandemic levels. And this is a market with much worse affordability than you had pre-pandemic as well. And so there are deals to be had. There are definitely sellers who are sweating it a bit in the Austin metro area.
There are counties in Texas that during the boom, the pandemic boom, over 50% of the homes sold were to investors. And, a lot of people don't realize that, these builders, well, first of all, there's a lot that I could say about the Texas housing market, especially in Houston and Dallas and those metropolitan areas surrounding them, is that there really isn't a whole lot of architectural considerations going on in these neighborhoods. They all look the same. They cram them in. There's no rhyme or reason. It's not that attractive in many ways, in my opinion. And, so what happens is somebody goes to sell an existing home that they've owned for 3 years. What's the benefit? I mean, how is your house any different than this new home that the builder's trying to liquidate and give away? And because like you had mentioned earlier, builders must sell. The difference between an existing home sale and a new home sale is in a lot of cases, the existing homeowner doesn't have to move. If they have a really cheap mortgage rate and they're managing to make ends meet, there's no incentive for them to go anywhere, where a builder's losing money every single day. A lot of these builders have shareholders to keep happy. They have bottom lines to consider, and they need to move this inventory. So it'd be interesting to.
Yeah, you're exactly right. Where this existing market, existing in resale, there's still a lock-in effect across the country. Even a market like Austin, there's not as much resale churn in the market, where somebody who has a home is selling it to go buy something else. That part of the market has really pulled back a lot. And so what has created active inventory is from two sources: builders, right? Because they're not going to stop. And then the other fact is that affordability is so squeezed that in some of these markets, homes are taking longer to sell. And as homes don't get bought as fast as they're getting listed, that's how you get that active inventory to build. But even a lot of these Midwest and Northeast markets haven't loosened up that much. And a big part of it is they don't have that new construction inventory who's coming into the market, doing some affordability adjustments, doing the mortgage rate buy downs to get the buyer's attention, which then, makes it harder to sell the existing and resale, and then the inventory builds there. So there's a huge amount of bifurcation across the country and even within markets right now.
All right, number three.
Number three, Northport, Sarasota metro area, Florida. So if you go through Southwest Florida, what's happened there is that, just like I gave you before with Naples, home prices went up a lot, home insurances went up a lot. The condo market has been shaken up by what's happened at the state legislature. But the other factor there is that Southwest Florida got hit by Hurricane Ian in September 2022. It was the third costliest hurricane in U.S. history. It might be second. I'd have to go back and look at I think it's third. Third costliest hurricane in U.S. history. And that created some additional supply of, some of these properties where, the roofs are damaged and they're like, you know what, I'm not dealing with this. I'm a retiree on fixed income. I might move back to Ohio, right? You had some of that occur. And so that, coupled with the fact that home prices went up so much, the fact that insurance went up so much, the fact with the condo market problems, that's created additional softening and weakness in some of the markets in Southwest Florida. And so Punta Gorda, active inventory there now is at 7,600 for condo and single family. If you go back to November 2021, and with active inventory, it's always best to compare by the same month, because there's a big amount of seasonality with active listings. There were only 1,400 homes for sale in November 2021. It's up to 7,600 now,
Wow.
which puts it 10% above pre-pandemic levels. And so you've seen definitely a softening and cooling in that market. And home prices year over year are down 5%. I think it's close to down 10% from peak. And if you look at the numbers, it looks like there's the forward-looking data looks soft and weak for Northport and Sarasota metro area heading into 2025.
Interesting. All right, number two.
Number two, we don't have to go far. Cape Coral, same thing. It's all the same thing as Northport. And so the market now has about 11,000 active listings. They only had 1,800, less than 2,000 active listings 3 years ago. They have almost 40% more active listings in the market today than pre-pandemic. And if you look at the data, one thing that also makes Southwest Florida unique is that it's one of the few areas where not only did migration slow down, but you've actually seen some net migration out of the market, where after, Hurricane Ian hits, I think some people threw their hands up and were like, enough is enough. And I think that's affected the market there.
Well, in Fort Myers, I can tell you because I had a friend that invested in Fort Myers. And back in 2008, and during that crisis and thereafter, there were entire condominium buildings that were never occupied, entire buildings that had never been climatized and yet were drywalled. And the drywall, the mold was growing off of the walls. I mean, these are communities that were completely bulldozed. I mean, big losses in Fort Myers. And, that was a really up and coming area, probably one of the most affordable areas in that region. And I mean, it wasn't that long ago where, you really could see the rebuilding taking place. So for them to take yet another hit, financially there is really sad. So, all right, what's the top city? What's number one?
Number one is Punta Gorda, Florida. They're down 7.3% year over year. I think they're down closer to like 12, 13, 14 from peak. Very similar story to everything I said about Northport's metro area, Cape Coral. Punta Gorda is just even more so. They had 600 active listings in the market in November 2021 during the overheating. That's now 3,600. That's actually 81% above pre-pandemic levels when you had about 1,900, just less than 2,000 active listings. And I actually did a story recently on Punta Gorda. Let me pull it up. It was one of the hardest hit housing markets back in 2008. It's a little sick again. The market, the thing that's interesting there is they were up 73% from above pre-pandemic levels within 18, 20 months during the overheating in 2020, 2021, into 2022 spring. Home prices just went up too much, too fast in Punta Gorda, and it's since moved into correction mode. And my guess is, probably sometime next year, it will be have weaker from March 2020 price gains than the national, which is incredible because it had 30% more gains during the pandemic housing boom than nationally aggregated data. And you can see here that Punta Gorda, it just ripped up. That's a bubbly, frothy market. There's a good amount of that out there in boom towns, but Punta Gorda was there to the max. Punta Gorda, it only has 200,000 people living in the metro. Pittsburgh has 2.4 million. It was building more homes than Pittsburgh, which is 10 times its size. So there was a lot of that new construction supply.
Lance, one of the things that I want to point out here, besides the fact that you've been covering real estate on a nationwide level for quite some time, and I know we've spoken several times before, and we have a couple videos on our channel, and your experience with Realtor.com really, I think, kind of got your creativity going for this industry. But I want to kind of focus on, because all of these slides that you're referring to, this is your own proprietary data. So I want to kind of give you an opportunity here to tell people what you're doing now, how they can stay following your information. I have several agents. As a matter of fact, before this recording, I just had a conversation with one of my top producers here, and he said he follows your stuff all the time. So you really are making an impact and educating. People are paying attention to you. But kind of tell us what's going on with your Resi Club. How can people get this information, follow along with you? Is it for the normal, everyday people that are interested in the real estate market, the professionals, the buyers, and the sellers?
Yeah, Resi Club, I really want to be people's data-driven gateway to the U.S. housing market. I'm deep into the data across the country, trying to figuring out what's going on for buyer-seller dynamics, what's going on for inventory and prices, what's going on in home building, what's going on in mortgage, connecting all the dots. And then as things move, like mortgage rates go down a good amount, what happens to refi? I want to be there to answer people's questions. And so people can go to resiclubanalytics.com, put in their email, and get signed up for my free newsletter. I also have a paid subscription, which is Resi Club Pro, where people get my metro and county level data across the country. But the other thing about it is I'm not just like throwing a bunch of data at you for the pro membership. I'm also in the articles walking you through exactly how to read it and telling you what's happening to really help to be people's guide.
Great. And I guess the big question that I have that everybody wants to know is, do you see a downward trend year over year, or maybe something that is making you wonder or concerned about prices in general in the housing market on a more of a macro nationwide level?
Yeah, so I have a little bit of a similar view that I had heading into 2024, which my view heading into 2024 is that I believe that the 2024 housing market would have a good amount of bifurcation, where the fact that resale inventory was still well below pre-pandemic levels, and in particular tight in California and Northeast and Midwest, I thought that that would push up nationally aggregated home prices for 2024, unless bifurcation, really, the weakness in the Sun Belt really moved. What's interesting right now is that I have a bit of a similar view to that, but it's not the same market it was 12 months ago. Active inventory now is 30% higher than it was a year ago, right? And affordability is just still as bad, right? And so I think when you look out to spring 2025, I do expect that some of these pockets of the Midwest and Northeast, especially some of these suburbs that have been fairly tight and there's not very much inventory, I think those places are going to have upward price pressure during the seasonally strong period. I think that a good number of the markets where active inventory has built a lot, if you have a market in the spring next year where things feel they're not moving much, right? Like prices aren't going one way or the other, that's a market where I would probably say, there's probably going to be some give up in the back half of the year, right? If you're flat in the spring. And so I think looking ahead, I would be looking at my own personal market if I was a buyer or seller, finding out how much inventory I have in my market right now relative to pre-pandemic levels. If you're still well below, there's probably a good chance that you're going to see some upward price jumps in the spring. If you're a market that shot up really quickly, we'll see what happens there, right? And some of those markets, as that's happened, like we showed today with D7, they have seen price declines. And so I think this 2025 market will be a bifurcated housing market, and it's going to vary across the country, across price tiers, and across zip codes. And a big part of that is just that affordability is so squeezed on one side, and then resale inventory from the lock-in or whatever you'll call it, and some of these markets still hasn't moved up. Right, existing sellers are really kind of staying, they're holding their ground, some of them. And even in some of these markets where actives have moved up, some of these existing sellers are, pulling their listings or not selling at the price that the market wants. And the wild card here to watch out for is the economy. These economists keep calling for unemployment to stay low. They think it's going to stay at 4.2. Goldman Sachs thinks 4.1, which is actually a little below where we are now. Wells Fargo thinks it's going to stay low. And that environment where existing sellers, there isn't much distress for existing sellers, that's probably a market with less give up, right? If these economists get it wrong and 2025's economy and labor market weakens faster than expected, or dare we say even goes into recession, that's a game changer. You need to bring me on your show because the data is going to change. It's going to be a different story, right? And that's where the bigger wild card is for the U.S. housing market.
Lance, we appreciate your time. And you mentioned Wells Fargo at a time where Wells Fargo thinks unemployment will be down as they just announced another 721 layoffs. That will be interesting to see how this market plays out. But thanks so much.
Thank you for having me.
Thanks so much for watching. And if you liked the video, you can let Lance and I know that you did by smashing that thumbs up. And one of the biggest compliments that you can do for me here at Sachs Realty is to share this channel with your family and friends so we can continue to build the most amazing online community together. See you next time. Sachs Realty, Maryland broker number 607720, office number 443-318-4514, equal housing opportunity.